Welcome back. In this session, we take a look at global indices or global indexes. In this session, we're going to try to get a better understanding of how these indexes are constructed and how they work and why they're important to us. Most importantly, we see that the global indices create a benchmark that we use to understand the overall performance of our portfolio, and it helps us at the end of this particular course when we try to understand how performance attribution works within a portfolio. Essentially, an index in general is constructed of a number of securities, stocks, bonds, commodities, private equity investments, for example. Those are the constituent securities. They're put into a security market index, and these indices or indexes are typically defined as being price return indices or total return indices. A price return index focuses in particular on the change in the share price from one period to another. A total return index includes the information that we get about things like dividends or interest payments that are received during the period, so we have a combination of both the price appreciation, the capital gain, as well as the increase in the value of the distributions. The value of, in general terms, of an index is essentially the sum of all of the prices in the index divided by a particular number. For a simple price return index, for example, the divisor or the denominator in this particular equation is generally set by the index manager at some point, and is usually set to create an overall value for the index at some particular level. For example, 1,000 or 100 as the original value of the index. And over time, the components, the stocks or the bonds within the index, as well as the divisor, might be adjusted. Some of the things that are part of the decision how to create a stock index: which target market should we use? In fact, we'll look at all of these things separately in just a minute, but these are some of the headlines. What target market should the index represent? North America, the world market, small companies. What is the target market that we're trying to define? Which securities? How broadly should we sample? Should we choose all of them or just a few? Which ones are we going to sample? How much weight should be allocated to each security? Will we weight them equally? Will we weight them by price, by market capitalization? How are we going to do that? What happens when the index needs to be adjusted, perhaps because one or two securities have become dominant within that particular framework? And when should what period should the security selection and the weighting be re-examined, perhaps reconstituted or reconstructed? To look at the first point, how do we decide what our target market should be? We need an index for just about everything. If we have a particular strategy that we call growth or value, if we have large cap, small cap, medium cap portfolios, we need to have a benchmark to use for those. And the good news is that because we have private organizations like Standard & Poor's that construct those indices, we do have a benchmark, we do have an index for almost everything. Think about the target market. Is it going to be very broad or very narrow? Will it be an index of all stocks or of one particular industry within that market? Will it be based on an asset class like stocks or bonds? Will it be geographically focused? North America, Japan, emerging markets, and so on. Or perhaps it could be based on an exchange, on the New York Stock Exchange, on the NASDAQ exchange, for example. And there may be other characteristics that will be part of that decision. Sectoral focus, for example, or high growth or high tech. There are different ways to construct an index or to weight an index, and the four most commonly used are the ones we're going to look at in the next couple of minutes. The most commonly quoted ones are the market capitalization weighted, but we also have at least one very famous price weighted index, We have equal weighted indices that are used for markets that are complicated, and fundamentally weighted for certain strategies. We'll take a look at those one at a time. The calculations are essentially structured the same. The difference is the information in the numerators, the denominators. The price-weighted one, the first one, is essentially just the price of an individual stock divided by the sum of the prices of all of the stocks in that index. So that would be the particular weight that's allocated to one stock within that index. Market capitalization weights use market cap or market capitalization, where Q is the share price. Q is the number of shares outstanding, and P is the share price. And we'll take the market cap for one company and divide it by the market cap for all of the companies' index. For an index like the S&P 500, then we'll take the value of all of the companies collectively in the Standard & Poor's index, and we'll take the value of, say, Apple, or the value of Alcoa, and that will be their value within that index. Equal weighted just says we're going to take a basket of one of each shares, and then we'll just say that that company will be 1/30th or 1/50th, depending on how many shares are in the basket. Factor weighted requires information about a fundamental or factor type of measurement. Essentially, it uses a measure of the company's size that's independent of the security price in order to create the weighting. It could be the sales, for example. It could be the book value of the company. So in that case, the factor is going to be a factor that's independent or separate from the share price. So, to look at each of these in turn, price-weighted equity index essentially takes the weight of each stock in the index according to the share price on the day. It's the simplest one to construct. The index value is just the sum of the values of all of the share prices in the index. And so we can go back historically and take a look at the value of the index right to before the index was constructed. Unfortunately, it requires some adjustments because individual companies with the index may have share splits, which will reduce the price, but obviously not reduce the value. And we may have additions and deletions to the index, and I'll show you a great example of that in just 1 minute. Again, our index performance might be skewed by some very high-priced stocks. Imagine, for example, if you had a stock like Berkshire Hathaway in your index, and it's priced at $240,000 or $250,000 for one share. It would clearly outweigh all of the other shares that are listed on that index, so we wouldn't want to have them as part of our index. The performance overall of the index represents the effect of buying and holding one share of each stock in the index. And of course, the best known of these is the Dow Jones Index. The Dow Jones Index is one of the earliest indexes that we know of. It was originally produced about 1896 by Charles Dow, who was an editor for the Wall Street Journal. Originally, it had about 12 companies, and most of those companies had names like U.S. Steel or American Rubber, and they were clearly 12 famous, well-known American companies. And fairly easy to construct this index. How's the Dow Index doing today? It's up, it's down. Just look at those 12 stocks. Of the companies that were in the original Dow, only one of those survived into recent days, and that was General Electric, and they got booted out of the index in 2018. So now there are none of the original components of the Dow Index. If you have a look on Wikipedia today, you'll see the current membership. It includes companies like American Express, Boeing, Caterpillar. Apple was a recent addition to the index as late as 2015. And since the Dow Index is constructed of only 30 companies, in order to join the index, they have to kick somebody out. So you can see that when Goldman Sachs, Visa, and Nike were added a couple of years ago, companies like Bank of America, Hewlett-Packard, and Alcoa had to be kicked out. So there can only be 30 at any point in time. In order for Apple to join, they kicked out AT&T. And Apple, in order to meet the requirements of the Dow Index, had to have a low enough share price that it wouldn't skew the distribution. And so they had just done a stock split in 2015, a 7-for-1 stock split, which brought their share price down from about $700 a share down to under $100, which made them eligible to join the index. Of course, if one stock becomes tremendously valuable in a price-weighted index, they tend to dominate. For example, if you have a company like Boeing, which currently has a share price in the $300 range, when they have a bad day, the Dow has a bad day, because one individual stock can move that market. So those are some of the pros and cons of the price-weighted index. More commonly, we use value-weighted indices, and essentially here we're talking about market capitalization. Of course, you remember market cap is the share price times the number of shares outstanding. The weight is based on the number of shares that are in circulation, or the float, not the number of shares that have been issued. And so essentially it ignores the non-publicly traded shares. A company like Facebook, for example, has got a lot of shares which are not publicly traded. They're controlled by some of the founders like Mark Zuckerberg. A value-weighted index adjusts for changes automatically. It means we don't have to do as much management of the index. And it tends to be also biased towards the companies that are the largest. But in this sense, the companies that are the largest by market cap, not the largest by share price. The best known of these would be the Standard & Poor's 500 or the TSX 300, some of the indices that we hear quoted on a daily basis. Another alternative, less commonly used for major markets, but also used for some of the specialty markets, equally weighted equity indices. In this case, the weights for each stock are equal. If we have 30 stocks, then you're 1/30th of the index, or 3,000 stocks, you're 1/3000th. Because of the simplicity of construction, sometimes the index has to be checked out and rebalanced or repriced because we have large changes in the overall weight, and things like stock splits also might affect those. Some of the smaller stocks might tend to make a mess of this because they may not trade every day. So if they're illiquid, then we don't have the information to quote all of the stocks in an index. A good example is the general approach to indexing that's done by organizations like MSCI. The Morgan Stanley indices are essentially constructed for countries, for size, for styles, for particular sectors. And so they have an index for almost everything. If you want to know what the value of the Brazilian market is, priced in US dollars, they probably have a market for that. One example that I can show you, from looking at their website, I've downloaded a list of the membership of the MSC Frontier Market 100. If you're wondering what a frontier market is in terms of developed markets, emerging markets, frontier markets are the markets that come after that. And so you can see that some of the best known players in this include national banks and telecom companies in countries like Kuwait and in Africa, Oman, looks like Pakistan. So we have a number of companies, substantial companies, that are traded on exchanges in different countries all over the world, but they're quoted in one place. And to keep things simple, they use the simplest index that we have possible, a simple average index. Some of the advantages and disadvantages then that we've seen, in summary, we have price-weighted indices, which are, like the Dow, are very simple to construct, but we have a few very highly priced stocks that can move the markets all by themselves. So a good day or a bad day for a company with a high-priced stock, even if it's not the most valuable stock, can move the market. We can have some arbitrary movements in the index and a need to rebalance the index on the basis of things like stock splits. The third one, the market capitalization, or the value-weighted index, is also one of the better-known ones. Securities are held in proportion to their value, market capitalization value. And it tends to emphasize momentum. So if we see that the market is moving in a certain direction, then the index clearly tracks. The equally weighted, simple. Unfortunately, we have some over and under representation of companies based on their values, and need to frequently rebalance and reconstitute that particular index. Fundamental weighted, again, where we may have inconsistent information about the value of businesses. We change the weighting according to a standard measure like the company's size or their book value. It may be contrarian, where the market capitalization is a momentum strategy. This might actually give us information that points to the opposite direction. And it requires constant refreshing of the information of the data. Now, that's an introduction to some of the types. We're going to take a look in the rest of the session at how we manage those type of indices, how they work, and how they may be rebalanced and reconstituted. Then we'll take a look at the application to some of the areas other than equity, because it isn't just about equity, it's also about bonds and bonds and commodities and so on. When we talk about rebalancing, essentially, when we see that rebalancing becomes a necessity when we have a change in the value and the change in the price of stocks, and perhaps we have got companies that are leaving and companies that are entering the market. So we end up with an imbalance. We end up with a couple of companies being overrepresented and other players, other pricing information being underrepresented. Essentially, we see that many of the indices regularly have to be rebuilt, reconstituted. So essentially it's like sending the index into the shop and providing some new parts and getting rid of some old parts. We'll start off by taking a look at the index as it was at the point that we reconstructed it. We'll set a date for the reconstruction, and then afterwards the index value will change. Perhaps it'll be 30,000 before the reconstitution. They'll take a look at the index, they'll reweight it, they'll rebalance it, and they'll start from scratch with a new value for the index like 1,000 and start all over again. And we've seen this happen to all of the major indices over time. As their values become higher and higher, the information, the number becomes less and less meaningful. And of course, we may have a requirement to kick some companies out of the index and to add some other companies. Even some of the broader indexes like the S&P 500 only represents 500 companies when other indices may represent as many as 6,000 sampling from the same market. So that's a quick introduction to the reconstitution. Now, before we say any more about indices, we need to think about why we need them. Most importantly, well, there are a couple of important reasons here, but one of the most common reasons is they're an indicator of the market sentiment. The first thing we hear on the news, well, depending on which news channel you listen to, is information about what's happening in the index today. The Dow was up, or the S&P 500 was down, the TSX was up. That tells us what the market is thinking about. And if we see a very substantial dip in the market because of a bit of new information, then obviously that information was valuable. For example, last week, John Bolton said, one of President Trump's friends said something about China trade, and stock futures markets dipped 500 points almost instantly. There was a scramble to refresh that information, and they told us no, the China trade deal was not over. It was, and of course, the stock futures market recovered. So the markets give us an indication of the effect of new information. It provides us for proxies for modeling things like return, risk, and risk-adjusted performance, because we say, how are we doing relative to these other guys? And the other guys are the broad index of our market. They help us to create categories and determine whether or not we have the right correlation coefficients we talked about earlier in asset allocation models, in our strategic allocation. And it provides us with benchmarks that we can use in order to gauge our performance. We outperformed the S&P 500. We underperformed the TSX index. Those are terms that you hear quite often. And of course, it gives us an opportunity to create specialized investment products like exchange-traded funds, or ETFs, that track those particular indices. And we'll take a look at those in a couple of minutes as well. When we talk about indices, especially when we're talking about the equity indices and stock market indices, we have a variety of different approaches to this. The broadest markets are ones like the Wiltshire 5000, which, believe it or not, actually contains about 6,000 stocks. It's a very broad market index. It includes just about everybody, much broader than the S&P 500, much broader even than NASDAQ, and so it includes a little bit of absolutely everything. Of course, a lot of problems in managing that index, and there's an awful lot of illiquidity at the bottom end of the market, so there may be some trouble interpreting that information. We can have less broad indices, like the S&P 500, are still part of a broad market index. Multi-market indices take a look at the effect of stock price changes across many different national markets. Emerging markets, for example, or frontier markets would be a good example of a multi-country market. MSCI also produces world indices that exclude the United States, world indices priced in US dollars or yens, and so those are all multi-market indexes. We also have sectoral equity indices, like Goldman Sachs produces a variety of indices, including semiconductor, but there could also be consumer durables or technology as a sectoral focused index. And there could also be styles, for example, small cap versus large cap, growth versus value, that focus on particular types of stocks and say, well, look at how well value stocks are doing today. From these indices, we see that there are a number of products that have been created in order to track the indexes. Historically, some of the earliest were mutual funds, which were set up to track an index. If you wanted to buy the entire S&P 500 index, but you only had $100, a mutual fund salesman could help you with that. They'd say, yes, we have exactly the product you need. We'll sell you a unit in our index mutual fund. And if the market goes up by 1%, the value of your mutual fund will go up 1%, less my commission. And so essentially, it's a mutual fund that buys shares. You buy a share from the fund or a unit from the fund and sell them back. And you can only do this on a day-by-day basis. You can't actively trade on a minute-to-minute basis. And the price is set at the market close. The cost of investing using this approach, or the management expense ratio, could be as high as 2.5 or 3%. Relatively expensive. The broader the index, the more people that belong to that particular mutual fund. Generally, the lower the cost, but still relatively expensive. You have your own account, and effectively you own the stake in the mutual fund, and you're subject to taxes even if you don't realize capital gains, or if you don't collect the capital gains or the dividends directly. A more recent innovation is the exchange-traded fund, originally popularized during the 1990s, but become much more popular in the last 20 years. They operate like a mutual fund, but they trade continuously. That means that they're repriced on a minute-to-minute, second-to-second, or even fraction of a second basis during the day. You're able to buy shares that are traded and quoted on stock exchanges. So if you're looking for a particular stock, like an SPY, for example, is a Standard & Poor's 500 exchange-traded index fund. It's marketed by one particular company. There's several other variants of it. The value of that particular exchange-traded fund is in the billions of dollars, and it's traded very actively. And the cost of managing that is a fraction of a percent, probably about 0.2%. So it's very cheap to manage. The dealers who manage the ETF can create and redeem shares by making in-kind deposits to the fund, or withdrawing or selling shares from the fund, from the pool of the stocks that are represented in the exchange-traded fund. They don't need to account to the registrars of those stocks for the individual investors, because essentially the stocks are owned by the ETF, and they don't need to buy or sell individual securities based on the investor's cash flows. Another example of this would be something like a product from iShares, which was originally founded by Barclays Bank and bought out by BlackRock. And they produce a variety of different ETFs. This particular one is based on the Toronto Stock Exchange Composite Index. And essentially it allows you to own the entire Canadian stock market. In fact, if you look down in the bottom corner, you'll see that one of the most commonly quoted or most commonly held items for Canadian investors is Royal Bank of Canada and Shopify. Shopify recently became the biggest stock by market cap, and it's very close to Royal Bank as being the most valuable. So they try to track the Toronto Stock Exchange and own exactly the same kind of things that make up that exchange. The purpose, of course, is to see that if the Toronto Stock Exchange goes up by 1%, then the value of the ETF goes up by 1%. You'll also see in the corner here at the right, we have assets under management, $6 billion, and they own 229 different stocks at the time of this fact sheet was printed. And so it's a very broad holding, but not a comprehensive holding of everything in the index. It's a huge amount of investment. And the management expense ratio, or the management fee, is 0.05%. It's a very small management fee compared to something like a mutual fund or a pooled fund. Now, an index separate or pooled account is basically the general category under which a mutual fund would fit, although it's probably better known, especially to American investors, as being something like a 401k or a retirement account. And essentially, you go to an investment dealer and say, "Hi there, I'd like to open a 401k." Well, they will take your money and they'll say, "Right, we'll put this money into investments," and then they will buy an index with that 401k, or they'll try to replicate it. So it operates a lot like a mutual fund. Now, another way that we can invest in indices without actually having to put up the full amount of the value of the index is to use futures contracts. Futures contracts are created derivative products that are managed by organizations like the Chicago Mercantile Exchange, the Chicago Board Option Exchange, the Montreal Derivatives Exchange. And equity index futures essentially track the index, and they allow you to buy into what you think the value of the index will be at a certain point in time in the future. If you have a bad feeling about the index, then you can take a short position, and if you have a good feeling about the index, you can take a long or a buying position. Essentially, they're futures contracts that can be exchanged for the actual index components, the basket of stocks that are represented by the index at a point in time in the future, or up to a point in time in the future. It is something that's quite often used, and we'll talk about strategies using risk management derivatives later in the course. It's a strategy that's often used to hedge against unfavorable movements in the market. If I wanted information about derivatives, I can see that there are quoted prices for stock futures with contract dates. For example, here we've got March 2014. It's an old slide. And that would be, if I was in January or February and the date for the contract that I was interested in buying was in March, I could see what the quoted price for that contract is. And for example, if the Dow Jones Industrial Average today was 1,450 and the price is 16.90, I would definitely say that looks like a very bullish future being forecast by the market. And of course, when we hear about futures markets moving in the out of hours trading right now, essentially what's happening is people are saying, look, the future's looking terrible because of this new information. That's why perhaps I should, when the markets open in the morning, I should start selling. So the futures contracts are something that are traded separately, and they do tend to, or they are available, that track just about all of the markets that we're interested in investing in. With the StockTrack trading platform, you'll see that you can actually buy and sell futures contracts that are based on indices. We'll have a chance to do some of that later on in our course. For example, on this screen, you can see that if we go into trading futures, for the European or the United States market, click on Indices, and the contracts that are available are limited, but you'll see that one of them is the S&P 500 that's traded on the Chicago Mercantile Exchange's Globex market. And I can see over on the right-hand side, I've kind of got a pop-up menu that showed up that shows that I can buy things like S&P 500, small number of contracts, E-minis, S&P 500 Global, traded on CME or Chicago Mercantile Exchange. I can also buy NASDAQ or Nikkei or Russell 2000 index futures. And those are all things that are available to me. I can even buy something called futures options, which we'll talk about a little bit later in the course as well. Now, if I wanted more information about those contracts, I would go to the original source, and even from StockTrack it does reflect next to the Chicago Mercantile Exchange, and I can see that there are a number of different contracts that are available. When I was looking at this a couple years ago, there's a March, a June, a September contract, and the quoted price for each of those contracts, it looks like the market was felt very, very poorly about these contracts, because you can see the values fall from 1837 to 1830 to 1824 and so on. They're traded on a regular basis, so I can see the trading activity during the day. I can see the number of contracts that were traded, so there were an awful lot of contracts for March 2014. And I can then click even further into this information and get things like the contract specifications. Now, for every type of derivative product, there's a separate contract. Essentially, it defines the derivative product, and you have to know what this stuff means in order to use it properly. For example, things like the contract size. Here, the cost of a contract is $50 times whatever the value of the Standard & Poor's 500 index. That's the total size of the contract. That's not how much you pay. And we'll talk a little bit more about that later in the course as well. But it does give us an idea of what the value of one contract for March 2014 for that particular index. It tells us what the size of the trading information is, or the tick size. It tells us what the contract months are and the settlements arrangements. And so we should go through all of that information before we decide to buy into those contracts. But again, that's a subject for another course. We've seen there are a number of different types of ways that we can invest in indices, invest directly in indices, or we can use the index information to help us manage our equity investments. But what about other types? What about things like bonds or fixed income investments? What about private equity? What about real estate, commodities? We also have to have a variety of different indices for those as well, but they're less well known and they're much more difficult to construct and use. An example of how this would work comes from looking at fixed income or bond indices. Now, bond indices are different from equity indices because they use information that's not provided from publicly traded information. Bonds are typically traded in dealer markets. So dealer markets sell bonds from their inventory, and the price information might not be as good. It's certainly not as up to the minute, and not all of it's public. Not all of it's made public. So it's harder to buy and sell bonds, and it's harder to construct bond index information. For a fixed income index, we'd need to know information about the number of securities. We have the problem of securities that don't trade publicly or don't trade at all, and perhaps lack of pricing information. Those are some of the challenges that we have. Some of the things that would also be taken into consideration is that there are several different markets within the fixed income market. We have global fixed income, we have regional, we have countries, currency zones like the European Union. There are government bonds, government agency bonds. For example, the Canada Mortgage and Housing Corporation is a major bond issuer in Canada, guaranteed by the government, but not the government. In the United States, Fannie Mae, Freddie Mac, and Ginnie Mae, Sallie Mae, all those great government funding organizations that are, again, private organizations. We've got mortgage-backed securities that may also be traded by organizations like CMHC, but they're also traded by the banks. And we have corporate debt. So these are the different types. And then we have different maturity buckets or categories like short-term, medium-term, long-term. And then there are the credit qualities. Of course, there's the investment grade, triple B and above, and then there's the high yield or junk bond, which are double B or below, and all of the individual categories within those. Aside from bonds, we have investment in alternative investments. And this is the first time in the course we've used the term, so I should provide a definition for that. Alternative investments are essentially that. They're alternatives to stocks and bonds. And that is pretty much a comprehensive listing. This is not. It includes some of the things that I would include. For example, commodities, investing in oil, investing in gold, silver, copper, wheat, jet fuel. Those are certainly things that we define as commodities. We can also invest in real estate, either directly by buying property or indirectly by buying property-backed securities. And we can invest in specialized finance vehicles like hedge funds and private equity. So can we construct an index for these? We have to try, although we're not as effective in this particular approach as we are with some of the others. For example, a commodity index has got a problem of pricing. The value that comes from investing in commodities comes from three sources. We have a baseline value, the risk-free rate. We have the gain or the loss in futures prices. And then we have the return that we get from holding onto the contract over time. So taking one contract and then another gives us an annual rate of return to holding those type of security contracts, or the roll yield. And all of those values become the price or the return part of the roll yield. We have some famous or some better known commodity indices, like Goldman Sachs manages a commodity index, and we'll talk a little bit about that later in the course as well as we start to use those benchmarks. Real estate, as I mentioned earlier, can be defined using two different types of real estate investment. We have direct and indirect. The best known type of indirect real estate investment is a real estate investment trust. And real estate investment trusts essentially buy properties and then provide the total return, the rents and the value of assets sold, back to the investors on a quarterly basis, essentially like a dividend. So they own properties, they may invest in mortgages, they may be REITs that invest in commercial property, in residential real estate. They even buy properties like university residences and manage those, or nursing homes. So real estate investment trusts may be very specialized. It becomes very difficult then to create an index that represents that, but I'll show you an example of that in a second. We also have information about pricing from appraisal indices and sales indices. The best known source of information about real estate performance is an organization called Nariet, and that follows the real estate investment trusts. And so here we have a variety of different types of indices that are produced on a regional basis and on, principally on a regional basis. Then we have specialized investments, and we don't cover all of them here. We will during the course, though. And one of those is a hedge fund. Essentially, hedge fund operates like a very large mutual fund. In its original design, it was meant to be fully hedged, in that all of the positions that they took in securities would be hedged using derivative markets, and they would just try to produce a slightly better, but perhaps highly leveraged, return on the difference. Of course, now hedge funds are essentially large mutual funds. They operate outside of the type of control that mutual funds do, because you have to be qualified to invest in a hedge fund. That means you've got to have a lot of money, and you have to be a sophisticated investor who is not likely to complain to the government when they lose some money. And so hedge funds have a lot more breadth. Now, unfortunately, what they do is not always done in full public view. So it's very hard to track those. We have a number of problems that come from trying to understand how well hedge fund indices work. Partly that's caused by the fact that reporting is voluntary. hedge funds can decide, no, we don't really want to talk about that particular fund, but we'll tell you about this other fund. Also, the hedge funds that fall out of the returns, and so we have something called the survivorship bias. It's kind of like in a class when half the class drops after a midterm. Then we say, well, look, we had an average performance, but it really wasn't average because half the class disappeared at the midterm. So we're only taking the surviving half of the class and saying they did average, when obviously they must have done above average. There may also be timing differences because quite often the information that's reported is reported from previous periods. And so that creates a lot of stale, dated information. Now, that's an awful lot to consider, and we really haven't made this comprehensive. We haven't talked about venture capital funds. We haven't talked about certain types of specialized securities, like trading in illiquid bonds or equities. Those are also types of alternative investments. We have hit on the major topics, the equities, the bonds, real estate, and commodities, and a little bit on hedge funds. In this session, we've covered a lot of ground in a very short amount of time. We said that there are a couple of different ways of looking at indices. There are indices that just track the share price and indices that track the total returns, the share price plus the cash flows from dividends and interest. We talked a little bit about how indices are constructed and why that's important, why it's important to understand that certain indices are price-driven and certain that are market-driven, fundamental-driven, or just equally weighted. We took a look at some of the weighting schemes and how they worked. We talked a little bit about rebalancing and how indices and when indices are reconstituted. And we looked at different types of and approaches to using market information, things like ETFs and mutual funds. And we also took a look at some of the other categories, so not just equity, but also fixed income, alternative investment, real estate, and so on. That's pretty much what we've got for you today, and it's certainly a good start. Of course, we'd encourage you to take a look at the course information for additional support if you want to understand better how equity indices work.